The debt peace theory, how economic ties prevent conflict. Question. What do you think of a theory that links peace to economic debt between nations? China lends money to the US, which the US then uses to purchase Chinese goods. Over time, US debt grows alongside China's production. This cycle ensures stability and peace between the two countries.
Your theory is based on the idea of mutually assured economic dependence, often called Chimerica, a term coined by historian Niall Ferguson and economist Moritz Schullerich. The idea is that China lends money to the US by buying US Treasury bonds, and the US then spends that money to buy Chinese goods. This cycle has historically created deep economic interdependence. Why it supports peace. Mutual economic interest. If China were to disrupt the US economy, it could hurt its own economy, as it relies on American consumers. Debt as leverage. The US benefits from China's willingness to finance its debt, while China benefits from the US keeping its economy stable and consuming Chinese goods. Production and growth. China's expanding economy thrives on exports, and the US plays a major role in that demand. Potential weaknesses. Shifting trade and geopolitical tensions. The US has been reducing reliance on China by reshoring manufacturing and diversifying supply chains, e.g., India, Vietnam, Mexico. Debt is not infinite. At some point, US debt levels could become unsustainable, or China might shift away from buying US debt. Political and military factors. Economic interdependence may not be enough to prevent conflict if political or strategic tensions escalate, e.g., Taiwan, South China Sea. China's domestic transition. China is trying to shift toward a consumption-based economy rather than relying on exports, which could change this dynamic.
Question. Debt is not limitless. Eventually, US debt levels could become unsustainable, or China might reduce its purchases of US debt. However, if China sells its US debt to other countries or investors, would the dollar's value remain stable?
That's a good point. If China decided to offload US debt, it would likely sell it to other countries or institutional investors rather than dumping it all at once, which would crush the value of US Treasury bonds and hurt China's own reserves. Why the dollar would likely stay strong. Deep global demand for US Treasuries. US debt is seen as one of the safest assets in the world. Countries like Japan, European nations, and global investors would likely buy US bonds if China sold them. US dollar's reserve currency status. Since most global trade is conducted in dollars, there is always demand for dollars and dollar-denominated assets. The Federal Reserve's influence. The Fed could intervene to stabilize the bond market if large sell-offs happened. Gradual unloading. China wouldn't want to hurt its own investments, so it would sell gradually to prevent a financial shock. What could happen if China sells too much too fast? Short-term interest rates spike. If a large amount of US debt flooded the market, bond prices would fall and interest rates would rise, making borrowing more expensive in the US. Potential market panic. A rapid sell-off could cause volatility in global markets, as investors worry about the stability of US debt. Yuan appreciation. If China dumped US dollars and converted them to other currencies, the yuan could strengthen, making Chinese exports less competitive.
Question. Why would the yuan appreciate if China sold off US dollars and exchanged them for other currencies?
Good question. The yuan could appreciate if China dumped US dollars and converted them into other currencies due to basic supply and demand principles in foreign exchange markets. Here's why. 1. Selling US dollars increases their supply. If China sells a large amount of US treasuries, it would receive US dollars in return. If China then exchanges those dollars for other currencies, e.g., euros, yen, or gold, the supply of US dollars in the market increases, which could weaken the dollar relative to other currencies. 2. Buying other currencies increases their demand. If China converts those dollars into euros, yen, or even its own yuan, demand for those currencies rises, making them stronger. If China were to buy yuan, the demand for the yuan would go up, leading to appreciation. 3. Stronger yuan means more expensive Chinese exports. A stronger yuan makes Chinese goods more expensive in international markets, reducing China's export competitiveness. This is why China has historically managed its currency to prevent excessive appreciation and maintain a trade advantage. 4. China's capital controls might limit this. China tightly controls its exchange rate to avoid wild swings in the yuan's value. Even if it sells US debt, it may not allow the yuan to appreciate too much, using currency interventions to stabilize it. Would China actually do this? Dumping US debt too quickly could harm China by decreasing the value of its existing dollar reserves, reducing demand for Chinese exports, triggering financial instability in global markets. So, while in theory, selling US dollars and buying yuan would cause the yuan to appreciate, China would likely avoid doing it too aggressively to protect its economy.